Hi, everyone, and thank you for joining us for today's webinar. It's called 2021 Tax Planning and Updates, and it's from the perspective of an accountant, Euri. Now, normally we have these webinars from the perspective of an accountant, a financial advisor, and an estate planning attorney, Donna, Euri, and Sophia. Today, we're going to start a series where we highlight or spotlight each individual professional. And today we're going to start off with Euri Yu, who is a CPA. Donna, of course, wanted to join us for today's webinar, but next slide. She had a baby, so she just had a baby on the 11th. So she's enjoying time with her new daughter, Caitlin Chu. So she won't be joining us today. So she's on the maternity leave. So congrats to Donna. Wanted to tell you that today, of course, we're spotlighting the accountant, Euri. Next month, we are going to be spotlighting myself, estate planning, and I'm going to be talking about basic estate planning. And after that, in April, Donna will be speaking about financial planning mistakes. So don't forget to register for the webinars, and we hope that you can join us for our next monthly webinars. Euri is a certified public accountant and her office is located in Fullerton. Donna Lee is a certified financial planner. Her office is in the city of Orange. And I am an estate planning, probate, and trust attorney with offices in Buena Park and Mission Viejo. If you have any questions throughout this webinar, go ahead and type them in the chat box. If there's time permitting, we will answer them as best as we can. If not, then feel free to send us an email and we'll get back to you after the webinar. Please note this webinar is being recorded, so do not take any screenshots. If you do need to, let us know beforehand. All right, so let's just get right into it. Euri, since we're talking about the tax laws, what are some of the new tax laws that will affect my 2020 and 2021 taxes?
Yeah, so 2020 was really an unprecedented year in a lot of ways, but also when it comes to just all the changes to tax laws. There was the Families First Coronavirus Response Act that started it all. That was enacted on March 18th last year. And that provided paid sick leave and paid family leave to people affected by the coronavirus. Then there was the CARES Act that was enacted just a short time later, March 27th. And this was a huge bill that had just a ton of stuff in it. This is what gave us those stimulus checks. It increased and expanded unemployment benefits. It introduced the PPP loan and the employee retention credit. It allowed for retirement distributions for, COVID-related issues, and just a lot of other things. Most recently, there was the Consolidated Appropriations Act of 2021. That one was enacted on December 27th, and that included the second stimulus check, a second PPP loan. It extended the unemployment benefits from the CARES Act, and it just adjusted some of the things that were in the CARES Act, like, related to like the PPP loan and employee retention credit and a few other things. And of course, we are expecting another bill very soon, probably sometime in the next month. I'll go into detail on that one later, but there's just a lot of things and a lot of changes to keep track of. So today, I'm just gonna go over some of the highlights and the issues that affected most taxpayers, and close with addressing some of the frequently asked questions that I get as a CPA. So first is the stimulus payment. So far, there's been 2 stimulus payments. Both had income limitations. The IRS used the income reported on the latest tax return that they had on file at the time that the stimulus payments were issued. But ultimately, those 2 stimulus payments are supposed to be based on your 2020 income. So if your 2018 or your 2019 income was too high to qualify, but you do qualify using your 2020 income, then this gets reconciled on your 2020 tax return. You can see here, it's on line 30 of the Form 1040. It's called the Recovery Rebate Credit. And it's in the section where you report like your payments and your withholding and any other tax credits that you get. So if you qualify for more than you received, then it's going to increase your 2020 tax refund. Or if you owe tax, it's going to reduce the amount that you owe. Another change under the CARES Act is an above the line charitable donation deduction of $300 for people that do not itemize their deductions. Typically, you only deduct donations if you itemize, but in 2020 and 2021, you can deduct up to $300 even if you don't. And so this is in addition to your standard deduction. This only applies to cash contributions. So your non-cash donations to like, Goodwill or Salvation Army are not going to qualify for this. And in 2021, the deduction is increased to $600 if you're married filing jointly. In 2020, it's $300 whether you're single or joint. In 2019, the IRS added a question to your returns regarding virtual currency. And that question was on Schedule 1, you can see on the right here. In 2020, they moved this question to the main Form 1040 right under your name and address. So I think this just really shows that this is an area that the IRS is paying special attention to. This is not going away. A lot of people have been very involved in virtual currency, Bitcoin, all those things. So if you are involved with virtual currency, just make sure that you keep really good records and that you report all your transactions. For teachers, the $250 teacher deduction now includes personal protective equipment and similar expenses like face masks, hand sanitizer, disinfecting wipes, things like that. They still kept the deduction amount at $250. And I mean, I've yet to meet a teacher that didn't spend like at least that much just on classroom supplies. So I don't know. I think it would have been nice if they increased the deduction amount, but instead they just expanded the definition of supplies. For 2021, what's lost so far is that there's a $300 a week increase to unemployment benefits. That expires on March 14th. There's also the Pandemic Unemployment Assistance Program, which provides unemployment benefits to independent contractors and gig workers. That's also been extended for a few more months until April. And as I mentioned before, there's the increase to the above the line charitable deduction to $600 for joint filers. For businesses, they can now take bonus depreciation for qualified improvement property. So qualified improvement property is defined as any improvement made to the interior portion of an existing building that is non-residential real property. So this doesn't apply to rentals or brand new buildings. Usually when a business makes improvements, you can't deduct all those costs like at once. You have to deduct it over a certain number of years, usually 39 years. But with bonus depreciation, you can deduct all of those costs in the year the improvements are placed in service. And this is retroactive to 2018. So if your business did a lot of renovations in 2018 or 2019, you can go back and amend those returns to take that deduction. Or I know a lot of businesses were closed for some period in 2020. And so if during that time you did some renovations, did some remodeling, this could result in a big deduction on your 2020 return. And if your business had losses in 2018, 2019, or 2020, those losses can be carried back 5 years or carried forward indefinitely. So if you are an owner of like an S corporation, an LLC, a partnership, and it had losses in those years, then this could apply to you.
Great, thanks, Euri. That was very important information, and there has been a lot of changes I can see. You've mentioned that there were some changes to the PPP loan. Can you go over some of those changes?
Yeah, there have been a lot of changes to this program since it was enacted. It's been like a full-time job just trying to keep on top of them. So I'm just going to do a quick overview, kind of the program, and just a disclaimer that these are the general rules. There are exceptions here and there in the rules and the calculations. So the first PPP loan was made available last year, and most small and not so small businesses qualified for it. There's no collateral, no personal guarantee needed, no fees. So, I mean, really a pretty good loan for a small business. The loan amount was calculated at 2.5 times the average monthly payroll costs. And your payroll costs included things like salaries, bonuses, some employee benefits, and state payroll taxes. And the loan, this is a big thing, the loan is fully forgivable if it's used on eligible expenses. And eligible expenses includes, all those payroll expenses plus rent, mortgage interest on a building, on a business property, and utilities, as long as 60% of the costs are related to payroll. The second PPP loan program is open right now. I believe at this time it's supposed to end on March 31st, but you never know what's going to happen. It's available only for businesses that experienced a 25% decline in gross receipts in any quarter in 2020 versus the corresponding quarter in 2019. The loan is calculated the same way as the first one, except if the business is in the food and accommodation industry, like a restaurant, a bar, or a hotel, it can use 3.5 times payroll instead of 2.5 times. And the definition of eligible expenses was expanded to include some other non-payroll costs, like expenses for worker protection, like plexiglass or a sneeze guard, or cloud computing costs that a business had to incur so that employees could work remotely. Some of the latest changes to the PPP program are that loans under $150,000 can now go through a very simple forgiveness process. The application is supposed to be just a page. You don't have to submit any documentation or copies of payroll reports or anything like that. You should still keep copies of those things for your records in case they ever request it from you, but it doesn't have to be submitted with your application. I believe the SBA is still working on this new application, so it's probably a good idea for most people to wait until it's released before applying for forgiveness. Another recent change is that the EIDL grant or EIDL advance no longer reduces the amount of your PPP forgiveness. So this was a grant that the SBA gave to businesses. It was $1,000 per employee. Originally, it was supposed to reduce the amount of your PPP loan forgiveness, but they reversed that. And also another very big change with the PPP loan is that now expenses that you paid with your PPP loan is now tax deductible on your federal return. So this was a very big relief to many businesses. Originally, California did not conform to that, just meaning that expenses paid with the PPP loan would not have been deductible. And this would have resulted in a really big difference between your federal taxable income and your California taxable income. However, just yesterday, things are changing fast. California lawmakers announced that they had reached an agreement on a COVID-19 relief plan. And included in that plan is the allowance for the deduction of expenses paid with your PPP loan, up to $150,000. I don't think this bill has actually been written yet, so we don't know many of the details other than just what they put in the press release yesterday. But hopefully more information will be coming soon. I think they're supposed to meet on Monday, and I don't know if they're just meeting to discuss it or to vote on it. But either way, it's probably best for any business in California that received a PPP loan to extend their return just until we have more information. And I also just wanted to mention that most grants are usually taxable for businesses. So if your business did receive a grant from your city or your county or any other organization, generally those are going to be taxable on your federal and California tax return. So that's the PPP. Moving on now, I just wanted to spend a few minutes talking about the employee retention credit. This credit isn't new. It's been around since the CARES Act last year, almost a year now. But now it's available to a lot more businesses because originally, if you received a PPP loan, you could not take this credit. So businesses had to choose whether it was better for them to get a PPP loan or to claim this credit. But including in the tax law changes from December, was that you could claim this credit even if you received a PPP loan. So this is a really good credit for businesses that qualify. So I'll start with the rules for 2020. To be eligible, businesses must have experienced a full or partial suspension of operations due to a government order. A partial suspension includes like a restaurant that's no longer able to provide indoor dining and they're doing takeout only or outdoor dining only. Or you can qualify if you experienced a 50% decline in gross receipts in any quarter in 2020 compared to the corresponding quarter in 2019. The credit is calculated at 50% of qualified wages, and the maximum credit you can claim is $5,000 per employee for the year. So let's say, you meet the qualifications, your revenue declined 50%. You paid your employee $8,000 that quarter. Your credit amount is $4,000. And so the difference between a credit and a deduction reduces your income. A credit is like a refund. So that is a $4,000 reduction in payroll taxes you have to pay. So it is like getting a refund of $4,000. Once you qualify for the credit, you can take it for subsequent quarters until your revenue recovers to 80% of the prior year. So you kind of have to do that calculation like quarter by quarter. For 2021, the rules are similar, but are just a little bit different to include more businesses. You qualify by experiencing a full or partial suspension of your business or a 20% decline in gross receipts in the first or second quarter of 2021. And you can compare that to the corresponding quarter in 2020 or 2019. Right now, this credit is supposed to expire in June, so that's why it's just the first 2 quarters, but anything can happen. So it could be extended for longer. The credit is calculated at 70% of qualified wages, and the maximum credit amount is $7,000 per employee per quarter. So for the first and second quarter, you could get up to $14,000 per employee. So the credit is very generous in 2021. There is a little debate right now between tax professionals and tax attorneys about whether this credit can be claimed for business owners. The rules were, anytime Congress writes laws and they're in a rush, there's some debate about how things get interpreted. So we're just kind of hoping that the IRS will release guidance on to clarify some of those things. You can claim this credit on Form 941. This is a quarterly payroll tax form that's filed with the IRS. It's 2021 now, obviously. So if you need to go back and claim the credit for 2020 wages, you do so on an amended Form 941, which is 941X. If you received the PPP loan, then you just need to make sure that the wages you use to calculate this credit don't overlap with the wages that you paid with PPP funds. So there is some math that you can do to make sure that you're both maximizing PPP forgiveness and also maximizing this credit. The calculation can get quite complicated, and there are some strategies that can be used. So I do recommend consulting with your CPA if you think you might qualify. Since there have been some big changes to this credit recently, it's likely, that the IRS is going to issue some additional guidance on claiming this credit, like how to claim it and clarifying some of the rules. So it is probably a good idea to wait for that guidance before amending any payroll tax forms and also before filing your 2020 tax return, since claiming this credit could affect your tax return as well.
Wow, that's a lot of information. Euri, is there like a deadline to file that amended 941?
I think it's like you have like 3 years from like the original due date of the report, like due date. So we still have some time. What I'm not sure about is I also read that there's a chance that, if you qualified in like quarters 2, 3, and 4, instead of having to amend 2, 3, and 4 payroll reports, you might be able to just do it all on one report, which would make things a lot easier. So that's the kind of guidance that we're kind of waiting for, just to see like practically, how this is going to work.
All right. So I know that there's talk about the stimulus bill. Are you going to be talking about the stimulus bill federally and also what was announced yesterday?
Yeah, I'll go over a little bit about what we think is going to be in the next stimulus bill and some other updates that have been announced. Of course, we don't know for sure what's going to be included. There's been a lot of discussion about what's expected to be included, but really until the bill is actually written, voted on, passed, and signed by the president, it's all guesswork because there's a lot of negotiating that goes on behind the scenes. But here are some of the things that are being discussed. Just so you know, these slides were actually prepared like 2 weeks ago, but most of what's on here hasn't changed. We just have a bit more information now. So the big thing that everyone is waiting for is the additional stimulus payment. This is supposed to be $1,400 per person. Because the last one was $600, they wanted it to be $2,000. So now they're making this one $1,400 so that at the end of the day, people are getting $2,000. They've mentioned including children that are 17 and adult dependents, both of which were excluded from the previous stimulus checks. I don't know why 17-year-olds in the tax code are like in this limbo where they're not quite children and they're not quite adults. And adult dependents would be like dependent parents and people like that. There was a lot of discussion for some time on what the income limitations were going to be. They discussed lowering them, but I think they pretty much settled on similar income limitations as the last two stimulus checks, which is $75,000 for a single person and $150,000 for married filing joint. If your income is above those limits, then the payment will be reduced until your income reaches $100,000 for single or $200,000 for joint, at which point you won't receive any of it. Similar to the first stimulus payment last year, these payments are going to be based on your latest tax return the IRS has on file, so either 2020 or 2019, and it's ultimately going to be reconciled on your 2021 tax returns. So we have another year of these to deal with. They're also likely to extend the boost to the federal boost to unemployment benefits. Right now it's set to expire in March, so they're really trying to pass this bill before those benefits expire. And they've also discussed increasing that boost from $300 a week to $400. Another thing that's getting discussed a lot is increasing the child tax credit. Some of the numbers I've seen are increasing it from $2,000 to $3,000 per child and $3,600 for children under 6. And also they've talked about including 17-year-olds who were previously excluded. And they also, I think, might tinker with the income limitations on this one too. This would actually affect your 2021 tax return that is filed that would be filed next year. And so they've been discussing providing it as a monthly benefit to families this year so that they don't have to wait until their tax return next year to receive it. They were also talking for a time about expanding the child care tax credit, but what I'm reading these days seems to point more to providing aid to schools and child care providers directly. So I'm not sure if they're actually going to make any changes to the child care tax credit that people claim on their personal returns. And they've also talked about a new grant for small businesses, something different and in addition to the PPP, and hopefully something simpler than that. There was also another kind of random bill that would remove taxes on up to $10,000 of unemployment income. It's called the Coronavirus Unemployment Benefits Tax Relief Act. It was introduced about 2 weeks ago, but other than the original announcement, I haven't heard much else about it. So I'm not really sure how much support it really has. If it was something that had a good chance of passing, I would think they would try to include it in the next stimulus bill, but I haven't heard anything about that happening. If something like this did pass, it would affect 2020 tax returns. So if you received unemployment income benefits in 2020, maybe you might want to wait just to see if there's any more traction on this bill. And another thing that was announced just yesterday, the House Ways and Means Committee, they wrote a letter to the IRS urging them to extend the tax deadline to July 15th, like last year. They think this will give, just provide more relief to taxpayers in terms of giving everyone more time to gather their documents and save up money to pay their taxes. Life has not really gone back to normal yet. So they just think that this would be a positive thing for most people. And it's also to give the IRS more time to catch up since they still haven't finished processing 2019 tax returns. Supposedly, the IRS still has millions of pieces of mail that they have yet to process. And so, giving them more time and, contacting them right now is very, very hard. They're just, they were shut down for a while, so they've been playing catch up for a very long time. Interestingly enough, about a week ago, the IRS had announced that they would not be extending the filing deadlines. So this seems like there's like some, disagreement between the IRS and Congress right now about, what's going to happen. So either way, I just hope that they announce it soon because being in this limbo is quite difficult. But for now, we just operate as if the deadlines are not changed and just don't be too surprised if they do get extended. And also remember that just because the IRS extends the deadline, it doesn't necessarily mean that the state is going to follow. So just keep that in mind as well.
Well, I certainly do hope that they extend that deadline, but I guess we won't know until they decide. Euri, what's some frequently asked tax questions that you hear?
So here's a big one that I get a lot is how the heck do I fill out a Form W-4? They simplified this form in 2020, and that's just created so much confusion. So here's what the latest form looks like. This is the 2021 Form W-4. I just wanted to point out a few areas that I thought were important. Of course, you start out with, filling out your name, your address, your social, and then your filing status, single, married filing joint, or head of household. Then there's this is like very important, very tiny little box in step 2. If you're single with 2 jobs or you're married and you both work, it's important that this box is checked. Because what this does is it takes into account the additional income that's going to be on your return. Your withholding is basically just an estimate of what your tax is going to be. So let's say someone makes $50,000, their filing status is married filing joint, and they don't fill out anything else on this W-4. Their withholding is going to be based on a joint tax return with $50,000 of income. But if their spouse works and that spouse also makes $50,000, then their withholding is not going to be enough because their actual joint income is $100,000. So that's what checking this box does. It's going to increase the amount of taxes withheld from your paycheck. The next line that I want to point out is on step 3. If your income is less than $200,000, if you're single, or $400,000 if you're married filing joint, you can enter on this line $2,000 for each child that you have under the age of 17. This will reduce your withholding because it's going to take into account the child tax credit you claim on your return. So you enter a number on line 3, and that reduces the amount of taxes withheld from your paycheck. Here's another common question I'm getting a lot this year, since so many people are working from home. Can I deduct my home office expenses? And unless you own a business or you're self-employed, the answer is probably no. And here's why. Because a lot of people say like, well, I used to deduct them. And it's like, yeah, you used to be able to, but they changed the tax laws. And so there's no longer a place to do that. On the left, you can see here a 2017 Schedule A. You can see here there's a line for unreimbursed employee expenses. Previously, if you were an employee and you had to like maintain a home office for the convenience of your employer, then you could write off some of your home office expenses here. The deduction was limited, but it was available. On the right is the 2020 Schedule A, and you can see that that line just no longer exists. It's just not there anymore. And it was one of the deductions that disappeared with the 2018 Tax Cuts and Jobs Act. And that act reduced tax rates, but it also got rid of and limited some deductions. So unfortunately, even though many of us are working from home right now, we probably can't deduct those expenses. However, if you own a business or you're self-employed, then most likely you can deduct those home office expenses against your business income. Another question I get a lot these days is, I'm starting a side business. Should I incorporate? And the answer to that question, as it is to a lot of questions I get, is maybe. There are a lot of good reasons to form an entity. Liability protection is a very big one. If you're going into business with someone else, that's another very, very good reason. It's also easier to raise capital if you're looking for investors, but saving taxes is a maybe. And the reason is because there are ongoing costs and administrative burdens with having an entity. Like in California, there's an annual tax of $800 that needs to be paid to the state every year, whether you make money or not. Pretty much like as soon as you organize, you got to pay that $800. There's also an annual or biannual fee of $25 that gets paid to the California Secretary of State. And $25 is not a lot of money, but if you miss the deadline, the penalty is $250, and it happens more often than you would think. If you're a corporation, you'll most likely have to put yourself on payroll and pay yourself like an employee, and there's costs associated with that. And there's the fee for preparing your business tax return, which is higher than preparing a personal tax return. There's also different rules on taking losses. So just because the business loses money doesn't necessarily mean that you're going to be able to deduct them on your tax return. So before you decide to form an entity, I do strongly suggest consulting with the CPA just to make sure it's the right decision for you and your business, and you fully know what you're getting yourself into. Either way, if you do have a side business or you're self-employed, just make sure that you keep separate books and records, even if you don't have an entity. It will make tax time a lot easier for you and help you make sure you're reporting all of your income and not missing out on any important deductions. You can just set up a separate, checking account or credit card or whatever, and it'll just make things a lot easier.
Thanks. I also want to add, if you have a corporation, you should probably keep up with the minutes and do those annually as well for the formalities. Your quick question on that home office expense. If you later go and sell your property and you're taking on that home office expense, is there anything that you need to do before you sell?
There might be some depreciation recapture in there. So usually anytime you have a home office, one of the expenses that you can write off is depreciation. And that's like a portion of the value of your basis in the home. But anytime you take depreciation expense, when you dispose of that asset, you have to add back those expenses. So it could affect the gain on the sale or how the sale of your home is taxed.
Okay, great. We have a few minutes. So one of the questions I know that you get quite often is, if someone just got married, should they file jointly or separately? And what's the difference?
I get this a lot. I get this question a lot from couples that are newly married. The answer is that it's almost always more beneficial for tax purposes to file a joint tax return. Once you're married, your filing status options are married filing joint, married filing separate, or in some very limited situations, you can file head of household. When you file a married filing separate return, there are some specific rules and limitations that you have to follow. And then California is a community property state, which means that generally all the income you earn while you're married is community property. So when you file a married filing separate return, on each return, you have to report 50% of each spouse's income. You split everything, the wages, the interest income, the mortgage interest you take on your home. Most everything is just going to get split down the middle. So you'll have to attach a worksheet to your return that basically just shows your math on how you split it all. There's also a lot of limitations and credits that you might lose out on if you file separately. For couples that do file separately, I've never seen it done for tax reasons. The most common reason I see is for People who, if one spouse is on a student loan income-based repayment plan. But other than that, usually it's for like legal reasons, like if one spouse is kind of shady or they have questionable activity going on, the other spouse wants to kind of protect themselves from that. That's a reason to file separately. But in short, the answer is almost always that joint is going to be better.
All right, good to know. Another question that we have, I'm sure you get all the time, is about the difference between using a CPA versus TurboTax. What can you tell us about the difference and maybe the benefit of one versus the other?
Yeah, if you truly have a very simple return, then TurboTax is probably fine. And so I define simple as like you have a W-2, maybe some interest income, but really not much else. And everything that goes on your tax return is provided to you on a tax form, like a W-2 or a 1099 or a 1098 or something like that. But if your situation is more complicated than that, like you have a business, you receive K-1s, you have a rental property, you receive stock options or restricted stock units, or you have a side gig or 1099 income, those are all situations where I think it's probably best or it's time for you to hire a CPA. And that's because all of those situations can require thought and input that goes outside of what is just reported to you on a tax form. I would say what I see with a lot of TurboTax users is that they are really only focused on the end result. So if their refund is reasonable and consistent, then they figure their returns are probably correct. And if they owe more tax than they think they should, then they'll kind of fiddle with the software until things are a bit more reasonable. I'm a CPA, I prepare tax returns, but I also really try to help my clients understand their tax situation and explain how certain life changes or life events might affect their taxes. I try to inform clients of upcoming tax law changes and how it might affect them. One of the questions I asked all of my clients when I do their returns is, what changes do you expect in the next year that might affect your taxes? Like having a child, getting married, buying a house, just so that I can help them prepare for how those things are going to affect their tax situation. Not that, taxes are really that important or anything, but, nobody likes surprises when they're doing their returns. So I try to encourage my clients to contact me throughout the year if they have questions or they're thinking about doing something that might affect their taxes, because I would rather know beforehand in case there's some insight or advice that I can provide, to add value to whatever they're thinking about doing. Because each person's tax and financial situation is really different, and life changes, they happen all the time. So I do think it's a good idea to have a relationship with a professional, especially one that knows you and is familiar with your situation.
That's really good advice. I know a lot of people did refinancing or they purchased or sold a home last year and this year. Is that also something that is not quite simple that maybe a CPA would best be suited to handle?
Yes, when it comes to refinancing, I know something I always ask clients for is a copy of their closing statement. And that's because when you refinance, you're not just going to get like one additional mortgage interest statement. Oftentimes, these loans are going to change hands multiple times. And so when you're doing your return, you want to make sure you're just not missing out on any of those mortgage interest forms, because that could be quite a large deduction. So there's going to be the lender that you refinanced with. A lot of times you'll pay mortgage interest to them for 1 month, and then they might transfer their loan to another provider for maybe another month or two. And then ultimately it's going to go to your final provider. So in the year that you refinance, you could get 3, 4, sometimes more Form 1098s. So if you're doing your return yourself, just make sure that you're tracking and making sure that everyone you wrote a mortgage check to that year, you're getting a Form 1098 from.
Good to know. And I think you really explained it well, that TurboTax, I kind of feel like it's after the fact, after you've done what you did, and then now you're trying to just report it on TurboTax. While if you go through a CPA, you can get ahead of the ball, get prepared, and have that advice too. Plus, you're combing through all the mortgage statements and trying to find every little thing to help with the taxes. So definitely a benefit to having a CPA. All right, well, this concludes our webinar. Thank you so much for all that important information, Euri. Just a wealth of knowledge, and I like how you're just staying so current on all the ever-changing tax laws. I want to invite you all to our next event. It's going to be in March 19th, 2021 at 12 p.m. Estate planning basics. This is where I'm going to be talking about, what's a trust, what's a will. If you're thinking, do I even need a trust? This would be a good webinar for you. A short survey will be sent to you after the close of the webinar via email. We would appreciate your feedback, and we know that your time is valuable, so we try to provide content that is important, that you will find useful. If you do have any other questions for us, our contact information is there. Please feel free to email us at any time. Other than that, thank you so much for joining us, and hope you will be with us in the next webinar. Thanks, everyone.